Hello, this is Rich Vessel, founder of Advanced Projections, with your December 2021 AP Economic Report. Here's our highlights in review. First, the Federal Reserve and the pandemic continue to exert their respective forces on the economy. The Delta infection and fatality rates dropped noticeably during October as predicted, but began at a major rate of increase during November, coincident with more indoor activity. This continues in December. The highly transmissible Omicron variant made its debut and has begun to spread rapidly across the globe. The infrastructure spending packages, the first $1.2 trillion portion of which passed Congress in early November, the spending from that will be initially slow to roll out as state legislatures will decide in early 2022 where they will be spending their apportionments. The debt ceiling has become a non-issue again. Inflation has picked up steam, but will it last? New employment gains in a strong October and November jobs reports pair with some of the strength hidden in the November details. Unemployment dropped to 4.2% due to a surprise labor force contraction, dropping to a level that made the Fed change focus as they just accelerated their tapering of asset purchases through early 2022 and interest rate increases scheduled thereafter. Equities climbed to new all-time highs early in November, but gave way as less than desirable inflation and pandemic news came out. So year over year, consumer price index comparisons and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies. CPI figures confirmed the onset of inflation during the second quarter, and they have continued to rise. The Federal Reserve had been claiming we would see only a temporary step-up of the inflation rate, lasting perhaps 1 year or so. This never did mean that most of the resulting price increases would come back down, however. The most volatile ones, food and energy, should eventually return to pre-pandemic levels as production and supplies are restored to normal levels, with energy prices now being the first ones to come back down. Oil has recently fallen from the mid-80s per barrel to about $70 per barrel, a decline of over 15%. Gasoline prices should soon follow. We are projecting a non-seasonally adjusted CPI at the end of the year to be 279, up from 260.47 at the beginning of 2021. That would imply an annual increase of 7%, which is going to get quite a bit of attention when those numbers are announced in late January. Unemployment, again, as we said, took another big dip down to 4.2% by the end of November. These inflation numbers, along with the strengthening employment numbers, have already induced the Fed to first announce and then accelerate plans to end asset purchases and increase interest rates. Just as we predicted, the Fed first announced in November that they would implement a gradual end to its asset purchases over the course of the next 8 months, going from $120 billion per month to zero in reduction steps of $15 per month. A December 15th update to this will be found later in our report, briefly describing how the Fed has accelerated this initial plan. The Delta variant of the COVID virus spread rapidly within the unvaccinated population of the USA, but appears to be burning through that population. Daily cases and fatalities were on the decline moderately, but turned around again with a renewed increase in cases. We are now again around 100,000 plus new cases per day in the USA, with a move up above 1,500 plus daily fatalities. These two rates have moved up from mid-October lows, probably associated with a retreat to more indoor activities and gatherings associated with the beginning of autumn weather and holiday gatherings. We had hoped to see a renewed decline in the weeks ahead, along with a stronger move towards getting at least 70% of all Americans fully vaccinated by the time we were solidly into the holiday season. As it is now, we have moved just past 200 million fully vaccinated Americans, or 60%. The appearance of Omicron variant has helped to convince some of the laggards that it is time to get their shots, but far more are still needed to step up. The large $3.5 trillion multi-year infrastructure restoration and improvement package, which had been negotiated in a bipartisan manner, and the $1.2 trillion initial piece broke loose and was passed by Congress in the first week of November. This should do good things for the economy in the long run, but it will be several months before state governments decide where to spend their allocations from this package. So the earliest any actual stimulus will result from this program will become first noticeable in the second quarter of 2022 and then beyond. In mid-October, the debt ceiling issue had been put back on the back burner as Congress kicked this can down the road for just 2 months. As we said here last month, it appeared it would be less visible for about 30 days more and then pop up again ahead of a new December deadline. As that deadline loomed, just yesterday, December 14th, Congress quietly increased the debt ceiling by $2.5 trillion without any of the theatrics and performance politics that had been wrapped into the September and October debates. Third quarter corporate earnings have come in well ahead of expectations with decent year-to-year comparisons against a dismal third quarter in 2020. Fourth quarter estimates have also improved. However, looking forward to 2022, the picture being painted by companies isn't nearly so rosy. Earnings increases in 2022 year over year are now being estimated at 9% with about 5% growth in revenues. Now here are the current underlying socioeconomic details. First, the current employment picture. In November, unemployment levels moved down to a national level of 4.2%. Recent data estimates show that businesses have 11 million job openings that they still want filled. However, a larger than normal number of people have recently retired or otherwise removed themselves from the search for work, and thus amplifies a decline in unemployment, reflected in the November 4.2% figure. The labor force participation rate had declined by 1.7% since February of 2020, just before the pandemic took hold, representing an active labor force decline of 2.7 million, some of which are due to a net balance of retirements and the rest mostly due to the consequences of the pandemic. If the size of the active labor force had stayed constant, the effective unemployment rate would be higher at around 5.4%. However, in spite of those earlier exits from the labor force, the participation rate has now begun to move upward again. Expectations for continuing improvement in employment and the labor force participation rate are still predicated in part on several assumptions, including no new COVID crisis. The national infrastructure package will assist by adding at least $120 billion per year in stimulating project-related employment, and on increasing urgent corporate labor requirements to sustain their profit and revenue growth. And we have included the numbers, household data numbers from the Bureau of Labor Statistics in a table in our written report. So you can take a look at the good trends that showed up in the November employment picture. Just as we expected, a downward trend towards an unemployment level of 4% would be viewed as a true full employment target for the Federal Reserve. The recent significant declines below 5% had led it to first announce in November that they would begin a gradual end to their highly accommodative interest rate and money supply policies beginning in mid to late 2022. This was clearly stated in the Federal Open Market Committee report or remarks following their November 2nd and 3rd meeting, where they gave a scripted tapering off of their current accommodative policies. And then the associated near zero short-term interest rates beginning now and running through mid to late 2022. Just 6 weeks later, on December 15th, with the unemployment rate heading down towards the 4% level and inflation heading up to 7%, the Fed has now modified it and accelerated their tapering program, which has been deemed a pretty hawkish move by some. This program is now designed to eliminate asset purchases by March of next year instead of mid-year, and to expect 6 to 8 quarter% Fed funds rate increases during 2022 and 2023. Now, in 2018, we had written to the Fed suggesting that they script their plans for the markets such that people could plan better on how to deal with changing interest rates and money supply environments. So we couldn't be happier than now that they have done just that. We had suggested a 2-year script, which was what was first described in November. But now we'll take the new 2-year script they have provided through the end of 2023 as a very positive sign in that regard. This helps remove a lot of risk and uncertainty from the economic environment as businesses and people have a better view of what lies ahead, and more concrete business and financial planning can be done. This reduced risk picture will, however, likely embolden investors and speculators alike. Now in the equities markets. In the first half of November, equity market prices showed a continuation of the September correction, but then have been since powered ahead several percent, setting new index records and again pushing deeper into bubble territory. S&P 500 earnings for the third quarter exceeded estimates for over 80% of the companies in that index. Third quarter earnings reports have shown year-over-year earnings for the S&P 500 up well over 40%, which is strong given the circumstances, but it is hardly anywhere near the amount that would be justifying the continuing leaps in equities prices over that same 1-year period. There are similar year-over-year growth expectations for the fourth quarter of this year due to comparisons against a depressed fourth quarter 2020. However, the markets should be looking 6 to 12 months ahead, and the estimates for S&P 500 earnings and revenue growth are far less aggressive, in the vicinity of 5% revenue growth and 9% earnings growth. We've included a 6-year chart courtesy of FactSet, which illustrates what's been going on in the past 4 years and the projections for the full year of 2021 and 2022 in terms of S&P 500 earnings and revenue growth. There may be more pleasant surprises showing up later in the second half of 2022, but businesses still face uphill challenges from supply chain constraints, temporarily higher energy costs, and higher labor costs, as well as labor shortages. In the past year, the markets have only taken one short-lived break along the way to nosebleed territory from the lows set in 2020. But a return to warm market levels would take the S&P down to about 3,500, and a correction to the mean would be near 2,800. We are still due for such a correction, but something will need to trigger it. The Fed's recent rescripting of their program will only make the markets more confident, and something else will have to come along to rattle the confidence of market speculators. So instead, it wouldn't be out of the question to see the S&P 500 penetrate the 5,000 level by the end of 2021. How long it will last there is just a guess at this time. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets. Heavy margin borrowing that is synchronizing with markets making significant new highs is a likely strong leading symptom for a market correction. In October, margin borrowing went back up another full 3.6%, back to a new all-time high. And we include a chart illustrating the level of margin borrowing against the S&P 500, courtesy of Advisor Perspectives. Now our individual indicator information. November's closing value for the S&P 500 keeps our APSI stock indicator as red, with that index still deep in blatantly overheated territory. One primary indication of the top-heavy nature in equities is the ongoing spread between the S&P 500 and our metric representing the GDP, the gross domestic product. Our AP chart illustrating what is more widely considered to be the Buffett indicator has been updated. We show several growth rate curves, and with the uppermost smooth curve delineating the boundary between a warm market and a hot bubble zone. We are now even deeper in bubble territory above the uppermost smooth growth curve, and our return to the mean would be down to the center blue line growth curve on that same chart. Finally, we have a chart courtesy of Advisor Perspectives, which continues to shout out how risky the U.S. equities markets are, using a set of 4 different equity market indicators, yet very similar to our own multi-indicator approaches. This risk indicator average was 181% 2 months ago, at 180% last month, and now sits at 190%, up a non-trivial 10% from the end of October. So the speculative risks in equities continues at all-time highs. And the status of our other recession predicting indicators. The AP-MS money supply indicator remains solidly green as the Fed has continued with their expansion of the money supply, having reached an estimated 22.23 trillion, up 8% since the beginning of 2021. But that will be curtailed over the next several months if all goes according to their recently announced tapering plan. Official third quarter figures for the M2 and velocity of money were released in late October. Our internal projections for the velocity of money was a drop to 1.15, which was exactly the number reported by the Fed. It is clear to us that the velocity of money has remained reduced by real spending curtailments, with a significant diversion of funds into less tangible and less productive speculative pursuits. For the fourth quarter of 2021, we expect the money supply expansion to have slowed somewhat and with a flat velocity of money. Gold prices bounced up in November to just above $1860 in the middle of the month, then fell back to the $1780 region by the end. Silver followed suit, pushing up $2 back to near the $25.30 an ounce range, but ended the month at $22.50. Rhodium had a relatively placid trading month, remaining near the $13,000 per ounce level. Platinum traded in tandem with gold and silver, moving up to $1060, that's $1,060 per ounce, and ended the month down below $950. Month-end prices for gold and rhodium keep our AP precious metals indicator deeply into the red. When year-end inflation figures are released in late January, it may be time for the metal bulls to start driving up the prices of precious metals with more zeal than recently. After the Great Recession, gold and silver showed plenty of bullish price action, with gold settling all-time records, which were not broken until last year's COVID financial scare. The October set of leading economic indicators from the Conference Board improved modestly, pushing our AP ally indicator a bit further into green territory. We continue to expect slight but noisy improvements to these LEIs during the next few months. The Conference Board maintained their improved outlook for economic recovery and that we should expect a more robust recovery well into 2022. so our LEI indicator will likely stay solidly in green territory for many months. All of this is predicated upon the absence of any overwhelming equity market correction or an unexpected worsening of unemployment during the upcoming months. Our APYC yield curve indicator continued green, now continuously for 7 months. The yield curve continues to move all on its own, maintaining a more normal shape with the short end firmly anchored near 0%, but with the 5-year down a few basis points and the long end down about a dozen basis points by the end of November. With the stated changes in Fed policy, we should see additional dynamics in the yield curve in the coming months as anticipated interest rate increases are realized. The APFD Fed indicator returned to green several months ago with the belated NBER and Federal Reserve official recognition of the end of Recession 2020, a full 15 months after the date they claimed it ended. Underlying financial system stability indices calculated by the Fed currently support this green status as well. The FOMC has now clearly stated they have the opposite expectations as their November meeting report included a highly scripted tapering program through mid-2022, pointing towards declining asset purchases and then minor interest rate increases. They amplified this, of course, in their December report. So if inflation pops up harder or longer than they expect, or further expansions of the large speculative bubbles become worrisome, the Fed may be forced to react, raising short-term rates sooner, and this may have the effect of collapsing the current equity bubble if it has not already done so under its own weight and imbalance. Should the economy weaken significantly, the Fed still has little left that it could do with short-term interest rates to further stimulate the economy if it becomes necessary. Greater asset purchases are its only remaining tool and would reignite huge increases in the money supply and the Fed's balance sheet. So they are treading very carefully along their path towards normalcy. Now that it appears we are going to emerge from the pandemic tunnel eventually, and expectations are now somewhat more optimistic, as reflected in more relaxed travel regulations, market and investor anticipations of the ongoing return to normalcy may continue for many more months, but increased dynamics and volatility should still be expected, especially if Delta or Omicron do not continue to rapidly decline. Right now, it doesn't look like they're going to rapidly decline, but we're going to have that winter surge. So in summary, we're moving into a period where our 6 standard indicators can be relied upon again for recession prediction, but we'll continue to augment that by a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several more months. Those are inherently less reliable short-term indicators of recession potential than the 6 AP indicators. With a new tapering script by the Federal Reserve, we have cautiously maintained our next recession potential at 25%. If equities or employment should unexpectedly plummet, that picture could change quickly. Of course, COVID is still the wild card in the picture, and its progress or decline must be reviewed weekly. We have oft-repeated our warning projection. History suggested that equities would tend to correct 10 to 12 months after the resumption of GDP growth, i.e. when a recession ended. Those months are the time period when corporate earnings roar back and then flatten out to normal. That suggested a potential window for a correction in the September to November of this year timeframe, based upon our November 2020 announcement that the recession of that year had ended. September and early October's correction has already met this criteria, but that correction was shallow and quick, and the recent Fed tapering scripts will keep throwing fuel on the equities fire for now. Something else must serve as a trigger for a deeper correction if it is to happen. So watch for weak 2022 earnings projections, which is now more than likely to overtake any other market concerns. We continue to maintain that this is an extremely risky equity market environment with the potential for significant and protracted drops or flash crash scenarios based upon the indicator extremes shown in our charts over the past several months. Only those with the higher tolerance for risk and a time tolerance for protracted returns to break even should be speculating heavily in the equities markets at these levels. So that's the end of our December report. We hope to see that you all have a safe, healthy, and happy holiday season, and that we will be returning to you in about 4 weeks with our January 2022 report. Thanks again.